Right now, you have to be so careful about who you listen to on the TV, because they're equating now, economists are equating now a slower economy with lower interest rates. You know, if that were true, then Zimbabwe's economy would be booming, and Venezuela, people would not be eating out of garbage cans. You know, this is not true. You know, all these economists, they have the same problem. They believe the textbooks that they had in college.
What goes up also comes down. And I suspect we might be heading into a depression with inflation. Some people call it stagflation, but this one is so severe because we have a global liquidity crisis. There's no money. It's drying up fast.
Well, you know, we said about a year and a half ago, we're going to go into a period of time that'll be terrible for people who are not informed. And I agree with your depression. I've been saying that. In fact, in early 2020, we wrote that we're going into a depression. If you want a roadmap, just read about the Great Depression of the 1930s. It's going to be very, very similar, except it will be worse. But they have printed so much now, they can't print much more. And we saw a warning signal. You know, usually before these events, like Lehman Brothers and so on, you have several smaller events that don't get much attention. In fact, the default rate on subprime mortgages was soaring in 2007. And Bernanke said, oh, that's an isolated situation, nothing to worry about, no recession in sight. And then, of course, we had the Lehman Brothers crisis in 2008, and everything fell apart.
What about this year, the Bank of England?
Exactly. I was just getting to that. That is the canary in the mine. When suddenly the pension plans had to sell their leveraged treasury bonds or gilts. They were leveraged. People had no idea that pension plans can use leverage and derivatives. You know, this is incredible. Nobody knew this. No. So suddenly they got margin calls. They had to sell their gilts to get money, and there were no buyers for the gilts. So the Bank of England had to come and buy the gilts from the pension plans. Otherwise, the pension plans would have gone bankrupt. You know, and this was the canary in the mine. This is going to happen. We have $177 trillion of derivatives in the United States. That is an unbelievable amount. 177 trillion, not billion. The four biggest banks in the United States hold 90% of those derivatives. Four banks.
And what people may not realize, when you have a liquidity crisis, it's because they're finding out their so-called assets aren't assets.
There's nothing forever. You know, what goes up will also go down. Now, you talk about precious metals, and I get this question very often. What should we do? And it's always good to have some insurance position in gold and silver. I kind of prefer gold, but what I really prefer is the mining stocks. The mining stocks, they're not going to confiscate. With the way the government here is right now, it's also very similar in the 1930s, where the government confiscated gold, okay? Right. So we could see that again. But they're not going to confiscate mines, gold mines, okay? But one thing, you know, you have to be very careful, because the people on TV, they're going to start saying when the Federal Reserve pivots. Pivot is an outer word. In other words, when the Federal Reserve changes from quantitative tightening to quantitative easing again, someday in the future, okay? And then they say that's when you really want to buy gold. In my opinion, well, not in my opinion, research shows that once the Federal Reserve starts easing money from a tight monetary policy, that's when the biggest part of the stock market and the gold mining stocks appears. They tank when the Federal Reserve eases. And this is always the big trap. People think, oh, the Federal Reserve is easing, now we got to buy. No, it isn't. If you look at the charts, this is when you have the last big strong drop in all of these assets. So you got to be very careful. And that's why if you look for an advisor, find somebody who has been in the markets for at least 44 years.
Right.
Why 44 years? Because they remember 1978, 1979, 1980. That was a very important period. It was the last peak in inflation in the U.S. You know, what's really important here is to know some history. Many of the analysts that everyone knows, they don't know history, or they don't want to talk about it. But in 1980, we had the peak in inflation. It was around 15% in the U.S., okay? Now, officially, we have 8.3%, okay, officially. But Dr. John Williams, who runs Shadow Stats, he calculates it the way they did in 1980, and he said it's actually 16.8%.
Yep.
So, and that puts us right in the range of all the big countries in Europe and so on. But what the important thing is, our Fed funds rate right now is around 3.7%. Fed funds. That's the short-term interest rates. The Federal Reserve says that's the rate we want for short term. You know what it was in 1980 when we had inflation like it is now? It was 20% Fed funds.
Jeez.
20% rate. People don't mention that. Maybe they don't know it, or they're trying to hide it from people. But there's another thing that is not mentioned. Powell, Fed Chair Powell, not the last meeting, but the one before that, he said our goal is to have the spectrum of interest rates. Spectrum meaning from short-term 90-day T-bills, let's say, to the long-end long-term bonds above the rate of inflation. So even if we take their phony rate of inflation, 8.3%, that means that interest rates will have to double from here. They're going to have to go over 8.3% to fulfill that. Nobody talks about that. Why are they hiding this? He said it. On national TV, he said it, you know? So this is so important. Interest rates are not anywhere near the bottom.
Interest rates just go up a little bit, and I was at a big major bank right near my house in Phoenix, and the whole place was empty. Not from customers, but their mortgage department is cleaned out. And, you know, Twitter just laid off, I don't know how many millions of people. Amazon's laying off people and all that. That's what that means. So we can talk about interest rates and percentages and all this stuff. But the thing is, as we said, what goes up must come down. What can a person do? You know, I mean, how do you think about this? And I'm concerned for everybody too, because they're calling for riots in Europe. China's in serious trouble, you know, because when we slow down, they slow down. So this is not just a U.S. thing. This is a global challenge we're coming up to. But this is not just China. It's Europe right now. You know, they're cutting down trees to heat their woods just to keep the greenies happy so you don't burn fossil fuel. I mean, give me a break. This is nuts right now.